YouTube, what's up? I'm Philip. This is Andrew. He doesn't really like my introduction, but that's okay because today we are going to tell you guys with 100% accuracy what's going to happen in the real estate market for the rest of 2021 and 2020.
Insert legal disclaimer.
For the rest of 2020.
And 2021.
And into 2020.
Yeah,
there we go.
Mention that too.
Yeah.
I think the first thing discussed, predictions are a bit questionable.
Not quite 100%?
Not quite.
Okay.
Daniel Kahneman, in his great book Thinking Fast and Slow, references this study he did with these stockbrokers, looking at how they beat the market year over year, and the correlation between how they performed over and above the market was like 0.1%, so basically nothing. Now,
the first point is nobody knows exactly what's going to happen.
Real estate is easier than that, and certainly Warren Buffett and Benjamin Graham as mentor have had a lot more success in the stock market, so it's doable. The first thing to just note, I don't think you can ever know for certain. You have to come in with a certain amount of humility.
Yeah.
So in stock market investing, they talk about dollar cost averaging, where you buy the same amount each year. So when it goes up, you buy less stock, but you keep buying, and when it goes down, you buy more. That's not really how you should relate to real estate, but the concept is somewhat similar. You shouldn't stop just because you feel like the market is too hot. I have friends who in 2015 were convinced the market is going to collapse.
They have predicted 9 out of the last 3 recessions.
Exactly.
So
I'm a basic economist.
Yeah.
And so, they're sitting on the sidelines waiting for the market to come down, and they've just been sitting and waiting, and they're still waiting. And so I was predicting, I predicted in 2019 that there would be a recession. Now, I guess I was right. I didn't predict a pandemic. I also expected it to affect real estate.
Yeah.
So you need to be careful in that respect. Jim Collins in his book Great by Choice talks about 20-mile marching based on Roland Amundsen, who was the first to get to the North Pole. Just every day, 20 miles, no matter what, good or bad weather. So it's kind of a consistent approach, just because you can't know for certain in investment. That being said, with these major disclaimers, legal disclaimer, all the rest of it, we are in quite an economic circumstance. Unemployment skyrocketed to 14.7%, which is the highest it's been since the Great Depression. It's down to 8.4%. That's still very high. Our national debt is annualized, 5.63 trillion. We spent 5.63. We brought in 2.82. So we basically spent twice as much as we brought in.
Right.
The national debt is anticipated. This is, I think, by the anticipated to go at over 100% of GDP, and is anticipated to go to 200% by 2050. Okay, that's a little bit of much prediction. And then we're looking at like all sorts of these scare studies. One study I'll put in the description, but 30 to 40 million people facing eviction, similar numbers of foreclosure, the $2 trillion CARES Act, that's kind of gone through the system. The $600 unemployment has gone down to $300, and who knows how much longer that will last.
So I have a question for you, Andrew.
Yeah.
All these numbers look bad. Why does real estate keep going up? What is happening?
Well, just real estate. I mean, the first thing is we have not had an issue with delinquency. I don't know any real estate investor or property owner or manager who has.
There has been
with
issues.
A couple
they haven't been 25% delinquency.
Yeah, for example, the National Multifamily Housing Council had in March, the month before the pandemic really hit, it was 93% people paid or paid part, and 89% in April, and that's probably been pretty consistent. We've had a tiny bit of delinquency, but July. I think July home sales went up 24.7%. A lot of that was because people were just kind of like
there's nothing on the market.
They were planning to buy, and then they're like, I guess we got to quarantine ourselves.
So nobody was selling, so the only things that were selling were going for astronomical prices.
Yeah, right now there's only 3.1 months of inventory. It's considered whenever there's less than 6, it's considered a seller's market. Seller has the advantage. Ever more than 6, buyer's market. Buyer has the advantage. We're at 3.1.
That's a hot
real estate. According to Zillow, real estate's gone up from 247,000 to 257,000 just this year from January, and we are in the middle of a deep recession, a very weird one where
real estate keeps going up.
We've had the stock market, the biggest dip in history, bigger than anything in the Great Depression, biggest rise in history, and now it's at all-time records, which is kind of odd for the middle of a recession. I guess the money printer go burr.
Yeah.
From
the one thing you can really predict, I think, is variance. It's going to go up and down significantly.
Extremely volatile.
And that's the
market.
one thing that I think you can. It's unpredictable right now,
Yes.
and I think that's the one thing that you can, with reliability, predict. It's
Yeah.
not going to be steady moving forward. Something is kind of.
Yeah, you should have shorted the market in March and then bought.
Which
in,
makes
like,
no sense, but it's
May
what's
or June.
happening. And,
yeah, but we've had extremely high volatility in the stock market. Very little in the real estate market. Just very low inventory.
Just keeps going up. It's really weird.
Yeah, it's not a little sharp, but but I think what this says to me is, again, there's no for certain. There's no 100%, but we are looking at a market that is likely near the top. We were in 2019. We had record high levels of personal, government. I think even corporate debt. Auto loans the highest, delinquent or mortgage defaults and things like that were ticking up ever so slightly, and there were signs that the market was slipping last year. There was the yield curve inverted, which is generally a sign that I think 80% of the time or something like that, after the yield curve inverts, you have a recession within a year. Well, that happened. I don't think the yield curve predicted the coronavirus. But there were lots of signs that the economy was kind of stumbling beforehand. We are certainly in a recession. The real estate market doesn't make a lot of sense. It's very hot, which leads towards the caution. Even in dollar cost averaging with stock purchasing, you buy less stock when it's high. Now we don't think that way with real estate, but I would say my recommendation to any investor going forward is at this point in time, don't be desperate to buy. Yeah, don't stop. You don't want to stop and just sit back. Jim Collins definitely recommends against hunkering down, as he calls it. The 20-mile marching every day, 20 miles every month, day, year, whatever you want to say it in real estate. Keep moving towards your goal. Keep looking for deals. Keep obviously building your systems and networking and the rest of it. But keep looking for deals. But I would not be desperate to buy. If you're looking to get into real estate, if you're a new investor, I would be more willing to sit. Not sit. That's a bad way to put it. But I'd say, don't. It's okay to not get a deal for a while. You really want to hit one that works. You don't want to. This is not the time to be pushing for a deal where you barely have any margin. No, with the possibility that we will have a fairly severe contraction, maybe a large. I don't think we have anything like 2008. I think these different things we've seen, where it's like 40 million people are going to get evicted, 10 million people are going to get foreclosed on. Yeah, those studies are. What is at risk mean? It probably means like they're living paycheck to paycheck and things are a little tight right now. And I don't think the government would let it happen. I think they'd print money until we go into Weimar and we have inflationary situation. So we're probably going. I would suspect we're going to sort of a 70s style stagflation. Of course, economic predictions are not worth a lot, but regardless, there's a highly volatile market. We're in a recession, and the real estate market is not behaving particularly rationally. Probably because the Federal Reserve and money printer go burr. But I think because of that, I would be very cautious and not sit on the sideline. Keep looking for deals, but make sure you have a good one before you go. And I wouldn't go with a big, giant rehab or something like that unless that's your standard operating and you've done it for a long time.
And depending on your goals, I'm not going to completely agree with that.
Oh, my God.
Because, okay, what Andrew was saying about if you're getting into real estate for the first time, I think the most important thing in this market is to not overextend yourself.
That's fine.
I think that's really important because if you're only buying one house or one asset with a lot of what you have to invest, that's a big deal, and that can really hurt you if that investment tanks. So don't overextend yourself. Be very careful of doing that. But when I think about, is the market going to boom? Is it going to bust? I just think a lot of that is irrelevant on the way that I like to invest in. Generally, Andrew's 95% on the same page about this. It just doesn't matter because what we're looking to do is buy an investment that is a good deal in the market today. If we're buying a deal that the market says it's worth $100,000 and we're buying it for $75,000, that's a good deal. Let's buy it. If we do that consistently and don't pay attention to what the market's doing, we're going to do really well. If we assume the market's going to tank, we don't buy anything, but it keeps going up, then we just missed out on a ton of opportunity. And if we think it's going to go up and we buy a bunch of stuff and then it actually tanks, we just lost all our money basically. So we just want to consistently buy properties that are undervalued, and we're going to do really well going with that model.
It's value investing.
Yes, it's Warren Buffett's model of you buy something that intrinsically is worth, you know, a certain amount. You know it's worth that much. You buy that much, and the market, what the market says, doesn't necessarily matter as much. And what we're doing is basically saying, this is what the market's saying. We're just always going to buy with a 25% discount. We're always getting 25% discounts. We're doing pretty well.
Yeah, I mean, he's even talked about, like, in The Intelligent Investor, which was from Benjamin Graham, Warren Buffett's mentor, like, occasionally they would find deals that companies weren't collapsing or anything like that, but where the market value was less than the book value, book value being just what they could liquidate all their assets for. There's obviously some sort of value there, and barring an extreme crisis going on in the company, they're being sued or whatever. And those types of situations, I mean, Warren Buffett and those value investors are the only ones who ever really beat the market. I mean, you know, Warren Buffett was in that famous bet he had with the, you know, with the hedge fund manager, where he'd go up against anyone who just bought an index fund and just crushed them. And versus the best hedge fund managers, the only way that you can beat the market in stocks is value investing, finding those, at least in my opinion. In real estate, it's obviously the best approach as well, and it's much easier because every deal is its own island. You know, every market is you're not necessarily competing with everybody.
That doesn't mean things don't change in a hot market and a cold market. In a hot market, it's really hard for us to find value investments because everybody's buying everything. Nobody wants to take a discount on their house. So it's really hard to find stuff. You buy stuff for less. Rental values don't necessarily match up with purchasing prices. So it might be harder to find things that cash flow when real estate's really hot. So depending on your goals, depending on your strategy, if you're a flipper, this might matter a lot more to you, but and how you approach things. So depending on your strategy, it does change. But I generally go with it. Don't try to predict the future. Don't overextend yourself. Buy something that you can make money from consistently because of the strategy you're using. And if it goes up or it goes down, your strategy is built in to take that on.
And I would just, I guess a small disagreement, I would say be more cautious. Don't be desperate. Well, never be desperate to buy, but don't be, it's okay not to find anything. It's okay to shoot out offers and get nothing for the time being. And if you're a new investor, definitely be careful. This is not the time to overextend yourself or reach on anything.
Well, we did it. We told people with 100% precision what is going to happen in the market.
Don't screw up. Something will happen.
Yes, something will happen, we think. Maybe
It'll
not.
probably go up or down.
Anyways.
Probably both.
But thank you guys for watching. We really appreciate you guys watching.
Subscribe, like, Facebook, Instagram, YouTube, Snapchat, all the rest of them.
Wolf,
Twitter,
is that
MySpace,
the one from
WeChat?
The Office?
Yeah, Wolf. WeChat. TikTok, if it hasn't been banned yet, do it. Thanks, guys.